Good morning, everybody, and or afternoon or good evening, depending on where you are in the world. My name is Matthew Lamb. I'm the CEO of Pacific Asset Management, and absolutely delighted again to be hosting the dVAM Investment Managers Live webinar. Clearly, a lot has happened since we last spoke on the 25th of March, which I think we were in the depths, of the news and the stock market's sell-offs. I think a key message was sometimes one has to look through the sell-offs and get a greater level of clarity and see how markets really truly react, because as long-term investors, ultimately that is the best way to participate in long-term growth. I'm pleased to say since then, through huge government monetary and fiscal stimulus, we have started to see a stabilization and obviously subsequent a rally back in markets, and from the low, some markets up in excess of 15%. Delighted to be joined by Will Bartleet, CIO and portfolio manager of the Pacific range of multi-asset funds. Matthew Roberts, partner of Fulcrum, the investment boutique that was set up and founded by Gavin Davis, the ex-chairman of the BBC. Matt's responsibility runs the dVAM, Diversified Liquid Alternatives Fund, with a focus and flavor towards more modern investments and things like social responsible investing, making a big chunk of their universe. Ian Mortimer, co-portfolio manager of the dVAM Global Equity Income Fund, and works at Guinness Asset Management, really seen as the #1 go-to global equity income managers in the marketplace today. So fantastic to have him on board. And Charles Hepworth, portfolio manager of the dVAM multi-asset active range, which is a portfolio active managers that works at GAM and has been running money for 25 plus years. So it's great to have Charles on the line too. We have a huge amount of attendees on this call, in the hundreds. So questions are probably best taken via the Q&A panel at the bottom. So feel free to ask questions as we go through, and I'll try and address them over the next 40 minutes or so. If we can't answer questions, please reach out to your dVAM advisor. I know we have advisors and clients on the call today, and I'm sure that they will be there to answer any questions and can filter anything back through us. So without further ado, let's crack on. Well, why don't we start with you? Maybe you could give us just a very brief overview of kind of what's happened in markets since the 25th of March, and maybe highlight some of the monetary and fiscal stimulus that we've seen, which I guess is what buoyed markets over the last 4 weeks.
Yeah, absolutely. And one of the things we talked about on the last call was really the extraordinary speed and scope of the response of the central banks, and that's really continued since March. It's worth remembering, in the last crisis in 2008, the central banks took some time to realize the severity of the problem. The ECB actually raised rates in 2008, whereas this time they were very much ahead of the economic impact that we've seen, with an extraordinary level of both in terms of the scale and the speed and the breadth of response. So we saw the Federal Reserve cut interest rates twice, both in emergency cuts, unleash unlimited QE. In the month of March, central banks globally purchased more than 5 times more than they did in the peak in 2009, $1.4 trillion worth of assets. And they've also moved beyond what they did in terms of the range of assets they purchased, buying corporate bonds, even moving into high yield bonds for the first time in history. And then the response from a fiscal perspective, from government spending, has also been extremely significant. In the US, a $2.9 trillion package, that's around 15% of GDP. Japan, a $1 trillion package, around 20% of GDP. So extraordinary level of stimulus to support the economy in what is clearly a very challenging economic environment, which has been really partly, of course, the choice of governments to shut down economies quite sensibly to preserve the healthcare systems around the world. And so this stimulus has really been to support economies through that process. And as a result of that, we've seen this significant bounce back in markets. I think the most important part started actually in mid-March, when we saw, ahead of some of these actions, we saw both bonds and equities falling. But the first phase of QE really arrested that, and we saw bonds starting to behave more normally, government bonds rallying even as the falls continued in equities. And then as investors got more confidence that central banks have produced a backstop to some of the worst of their fears, we've seen a sharp rally both in equity markets and also in areas of fixed income, including credit markets, particularly those supported by central banks.
Great. Matt Roberts, is there anything you want to add to that? I guess also delving into some of that a little bit. What are the implications of all this government support for companies that might be lower down the credit spectrum?
Yeah, okay, thanks, Matt, and hello everybody. I guess one of the things that we've been thinking about a lot is we've been through the big liquidity shock event that took place in February and March, and then sort of we've had the subsequent announcements on stimulus, fiscal and monetary stimulus, and that has been sort of broadly speaking absorbed by the markets now, and it feels like we're now in a phase where we're getting these sort of idiosyncratic events occur. A few days ago, it was the oil price falling by over 200% in a day, and tomorrow it might be a XYZ company goes into administration, and there will be some of that. And I think the overall theme that's coming out of this for us is that we're all really well aware of some of these long-term mega trends that exist in our economy today. You've got the technological revolution, the evolution of climate change and clean energy, and demographic changes, and all these big long-term megatrends. And what we think is happening at the moment is that there's an acceleration of some of those megatrends. I'm sure that a lot of people on the call are using Zoom and tools like that a lot more frequently than they were before, and so the environment is sort of forcing us to do some of these things, and as a result of that, there are going to be some winners and some losers out of this. For example, if you take the real estate market, you've seen a really massive rally in some digital infrastructure, digital real estate, cell towers and data centers and things like that. You've seen logistics and warehouses do well. Imagine Amazon packaging and all these Amazon warehouses around the place, still doing loads and loads of business. And then you're seeing retail really struggle, and that's that's not going to solve itself quickly when we come out of this. And so there are going to be certain sectors, certain companies that really suffer. And I think so therefore part of the challenge for us all as fund managers and stewards of capital is to ensure that we're sort of tilting the portfolios in a prudent way towards those sectors that are resilient and that are going to benefit from these types of changes that are definitely being accelerated because of this particular crisis. And I think there are definitely going to be some big opportunities as a consequence of that. And one of the things I was thinking about the other day was that there was the old example of when the Netflix bosses went into the Blockbuster video offices in the late 1990s and asked asked for some funding because they were interested in developing their live streaming technologies. And the Blockbuster boss laughed them out of the room and said that, no thanks, we're okay, thank you. And it wasn't many years after that when Blockbuster Video went into administration. And we all know where Netflix is now. And I think that sort of innovation and adaptability is what we're going to see more of, and is what will lead to certain companies being successful through this.
And I suspect, maybe one for Ian, I suspect it will also see some of the older school companies that probably haven't innovated as fast as they should realize, and the need and necessity to do that. There is you mentioned oil and you mentioned commercial property. I want to touch on those later, but let's just crack on with Ian a little bit. We're going through reporting season. Matt's talked about winners and losers. I think, clearly an opportunity probably for active management, but given your income, dividends, where are we seeing that? And are companies being forced to cut dividends? Are companies being prudent around dividends? How's that affecting income?
Yeah, I think the headlines look extraordinarily negative from an income perspective. If you're in the UK, you're seeing, reductions of the sort of FTSE benchmark sort of dividend dropping 40 to 50%. You're probably seeing similarly if you're looking at in Europe at the stock 600, for example, and there's some expectation in the US that it might drop by, say, 20 to 25%. So looking very negative for dividends. And really the four main reasons that companies are cutting or cancelling their dividends are sort of regulatory risk. So things like the European Central Bank urged banks in Europe not to pay a dividend. They also did the same for insurance companies. If you're taking US government bailout money, you're not allowed to pay a dividend or do any buybacks. There are some political pressures. So in particular in France, the government has told companies which they own a stake in, they're not allowed to pay a dividend. So things like EDF and Thales, so these are massive companies. And they've also asked companies to show solidarity and cut by at least 30%, kind of regardless of whether they can or can't. The third pod is really sort of financial pressure. So that's the companies who are in trouble. So they're your sort of hotels and travel and leisure, for example, some of the commodity stocks where their revenues have just disappeared. So therefore they are unable to pay a dividend, if you like, without getting into sort of serious financial distress. And then there are some companies being prudent, just maybe keeping dividends flat rather than growing them because they're not quite sure what the outlook looks like. And then I guess a fifth pot might be sort of technical issues where companies have been forced to delay their AGM because they're not allowed to meet in person and they require a vote to actually pay that dividend. But if you kind of put all of that together, that does sort of show you why places like the UK and Europe are hardest hit. Lots of banks, lots of companies with government stakes, for example, and some areas like commodities, particularly in the UK, being hard hit. But if you sort of look under the headline, what we're seeing is actually certain areas of the market are still doing okay. Consumer staples companies generally have been very positive and have continued to pay their dividends. We've seen companies like Johnson & Johnson and Procter & Gamble actually grow their dividend by 6%. Healthcare is clearly doing very well, and some businesses we own in that area continuing to pay their dividend and also growing it. And then other areas that you might not associate with income, like IT. These are companies that have gone into this with really quite high cash piles, very strong balance sheets, and actually in some instances are doing well. Things in this environment, things like cloud computing and demand for semiconductors, etc., is holding up quite well. So really kind of the way we're looking at the income from our perspective is, yes, the headlines are very negative, but actually if you're in the right areas, there's still some actually very good businesses continuing to pay. In fact, sort of in the portfolio we're looking at, we've still had no companies actually announce a cut or a reduction in any of their dividends so far this year.
Okay, and so just on that, let's just touch very briefly, because Matt talked about it as well, on technology. Are many of these technology companies almost becoming, utility type companies? They've gone through their growth phase and now they're changing their model, and dividends could be something they do more of, or would that be frowned upon as a technology company because it looks, like an anti-growth strategy?
Yeah, I think it's definitely something that these companies will be looking at. And as you rightly say, if you look at kind of how they're positioned in terms of how big they are, how much the opportunity they have to invest in sort of profitable growth areas, then clearly, yes, we would expect more of these companies to start paying a dividend. The good example would be something like an Apple, for example. It's pretty moderate, their dividend at the moment, but that's something they're obviously looking at. I guess some of the companies we're looking at quite big would be in the US, so maybe they would take an approach of actually using buybacks, potentially to use up some of their capital rather than income. But I think one interesting thing we're seeing is, the demand for investors for yield remains strong, kind of regardless. And the areas that you can now find to achieve that are much, much smaller. So we believe that, some of these companies that we mentioned earlier, they're not only paying their dividend, but maybe growing it. On the medium term, they could actually be, bid up in the market because there's going to be less and less places to find that. And I think, companies will start to recognize that. And, if you're paying a dividend or initiate a dividend, that might be actually quite positive for you in this type of environment. So that's also another kind of very interesting place for us to be thinking about.
Great, Charlie. I know that you got cut out earlier, so I'm hoping you're on the line.
Yeah.
Fantastic. Thanks. Let's talk a little bit about, and this is maybe for Will and Matt too. But why don't we kick off with you, Charlie? Well, Charlie, specifically two things. One, touch on gold briefly, because I know that's a holding in your portfolios, and whether that's got too far, whether you feel you should continue to hold it, and then maybe briefly after that, a little color on, we've touched on oil, and we'll go to everyone on this, but is oil telling us that the economic recovery is very different from the stock market recovery, and should that be a sign of concern? But let's kick off with gold first.
Yeah, so the gold position we had on, we're really using that more as a safe haven play than it's probably ever been before for us. And it has performed exceptionally well this year. Clearly, it's probably one of the only investments on the portfolios that we run that's actually gone up close to 20%. We have trimmed it back a little bit because, as you say, it's kind of run away with events. And the focus now, I don't think is necessarily on protecting capital by using gold and safe haven. It's really trying to capture some of the returns that we can get in the other kind of disrupted assets that we have traditionally held on the portfolio, and that would be the equity kind of space. So it's done well. It's done exactly what we want. We're also using it as a sterling kind of hedge as well. We buy it in dollars. Our expectation for sterling is to still come under, still come under a little bit of pressure as we go through the year. And it's just there as a protective hedge asset more than anything else. It's not saying that we expect this is a dead cat bounce in the markets and we're going to allocate to more safe haven stuff by any means. In fact, we've been, as I said, we've been limiting our exposure to gold, coming slightly out of it over the last couple of weeks, given its strong performance. But it's always, I think, always going to be an important part on any portfolio construction because it does operate slightly differently to the other headline assets that we use. So you're going to have to use that just for diversification benefits more than anything else.
On the subject of dead cat bounce that you talked about, funny enough, that was one of the questions that someone has asked. Is this a dead cat bounce? From your tone, I guess you feel that maybe it's a little more than a dead cat bounce, and I guess driven by the sheer volume of fiscal stimulus.
Yeah, I mean, pretty much what the other guys on the call have said already. The governments had to act. They all knew that there was huge global output kind of lost with this developing crisis we've got with Corona, and we needed to see at least a $3 trillion kind of input just to stabilize markets. It's this. I think you mentioned on the previous call we had. Larry Summers' perfect example that economic time has pretty much stopped, but for that financial time hasn't. So we did need that kind of buffer from the fiscal and monetary side to stabilize markets. I mean, that was clearly obvious at the time, and they did react very quickly, which is exactly what we wanted. So that's helped clearly markets get to where they got to in the short term. They were impacting the R in that Gordon's growth model. So D over R minus G is your kind of valuation for an equity or a stock index. And it all equates right now to where it should be, given that kind of R has been really forced down. The cost of capital for companies has really been lowered down. So indices where they are pretty much at fair value. I don't think they've overshot. I don't think it's a dead cat bounce necessarily. But we are in this kind of containment suspended animation phase as we go through this crisis, and we will get through it. This isn't going to go on forever. We just got to make sure it doesn't snowball into something more serious, and we don't get into some kind of solvency and then another liquidity crisis again further down the line. So they've done exactly what they were expected, and had been expected by the markets to do. Regarding the oil price, I mean, that's more of a technical position, given right at the start of the crisis was starting to develop in the Western world. Russia and Saudi Arabia decided to go full kamikaze really on the oil price by over pumping and try and steal the market share and squash out all of the shale producers in the US. Now, it probably hasn't worked to their expectation, one would say, especially when you get this kind of weird negative oil price that we saw earlier on last month, or towards the back end of last month. But that's just down to supply. There's too much oils washing around the system. There's not enough container facilities to store it. And it's just a very weird environment that we now live in, negative rates and negative oil prices. It's quite strange, but these things aren't necessarily a sign on the global economy per se. It is clearly an indication, but it's not saying that we're going into a complete meltdown again. It's just a very, very specific technical feature of the oil market right now. There's just too much of it.
So let's just continue very briefly on the oil thing, and maybe one for Will. There is clearly too much oil. Some of that driven by the kind of excess pumping between Russia and Saudi Arabia, etc., that Charlie's just mentioned. But do you think it's also clearly a sign that there is no demand for oil. What does that mean in terms of, and obviously we've seen this huge unemployment increase around the world, particularly in the US, where 26 million people, I think, have been made unemployed in the last 6 weeks. What are your views in terms of market valuations and the speed of this bounce?
Well, I think the oil price is telling you that the global demand has stopped rapidly, and clearly it's massively exacerbated by the action of the Saudis, as Charlie alluded to, and I think equity markets at points in time look very divorced from the realities of an economy, and probably at the moment that feels the case. With the unemployment rate increasing at the rate it is, I think that what the important part of the bounce so far is this backstop from central banks, and at the worst moments in March, they were talk comparing this to the very worst events of the 30s, and I think central banks have done that. In terms of where markets go from here, I think the economic shock is still to play out. So a very rapid V-shaped recovery is probably less likely. But we've really removed some of the worst of the downside, and that really means you get more differentiation, as Matt alluded to earlier on, in terms of winners and losers, both in terms of the opportunities and in terms of valuations from here, which provides opportunities, I think.
I'm gonna carry on with, and I hope I'm not boring people with this bounce, because I'm looking at questions, and there are lots of questions around bounces, the bounce of the markets, the valuation of US equities. Matt Roberts, what is your view on the speed of the bounce and the sustainability of that bounce, and opportunities maybe for the next sort of areas we could be investing in?
Yeah, I mean, and also, Matt, just trying to package that together with what we saw with the oil price move as well. I mean, I think that the thing that we have been really trying to focus on is, what does all this mean for which sectors are most vulnerable on a forward-looking basis from here, and where might there be some opportunities that perhaps haven't yet been taken advantage of to their fullest extent. And so, think about, what does a really low oil price mean? Well, generally speaking, I mean, if you have a low oil price for a sustained period of time, there are some sectors and some countries that would find that very, very challenging. So if you think about oil export countries, countries like Venezuela, countries like Russia, countries like Mexico, some of these types of markets will really struggle if you have a low oil price for sustained periods of time. And so that equities of those countries and the government debt as well is well worth keeping half an eye on over the next few years as we see how that low oil price plays out. It's pretty obvious which sectors are directly impacted by low oil prices when you look at the equity market. Just the oil producers is the first one you go to, but there are knock-on consequences in a whole range of other sectors as well. And thinking about things like, well, actually what that means is lower input prices for the agriculture sector, and that might actually be a positive thing for some parts of the agriculture sector. So trying to spot where the vulnerabilities might be.
Is that deflationary then, Matt?
Well, the initial move in the oil price is absolutely deflationary.
Which is good for the consumer, is it? Or
it's it might feel like it's a good thing for the consumer in the first instance, but it's not necessarily great that you get deflation in the overall economy for a long period of time. But I don't necessarily think it will stick around for a long period of time. As the economies reopen and people get back to work, I think that will probably sort itself out after a time. But I think what was really interesting to us as part of this, I mean, if you think value has underperformed growth in the equity markets for a very long time, and people have been looking at value stocks for ages, trying to figure out when they were going to come back. And the truth is that some of those value stocks are never going to come back. If you look at some of these retail companies, they're just not going to come back. But there are pockets, we think, within that sort of value realm where that's where you could see the really big upside from here, because maybe some of the money's been made in some of these tech names, and in some of these pockets within value, there could be some really interesting things. So I'm thinking, for example, about UK house builders. A number of these companies trading on 6 or 7 times earnings, and typically on the sort of way out of a valley in the economy and valley in equity markets. House builders and estate agents do tend to recover quite nicely, and they're trading at pretty depressed prices still. So that those sorts of companies could be quite interesting going forward, and maybe something to have a think about.
Okay, so let's pursue that that little thread, because I think there is maybe one for Ian as well. I think that there is a sense that people feel that there has been this very fast bounce, but that very fast bounce has to a certain extent been limited to very large cap US equity names. The FTSE still down 20% for the year. So question for Ian, I mean, where are you seeing the recovery, or where do you see the recovery next? Is it, are the new safe havens Google and Apple, that can trade at 30 times, or are there opportunities to pick up things that haven't bounced yet, where we are still seeing significant value?
Yeah, I guess that's ultimately what we're looking at very hard, I'm sure, as everyone else is. I think in terms of sort of how we take an approach, especially thinking from a dividend perspective, the main thing we've been focusing on is sort of balance sheet strength. That's something we always do, but it's become even more important, I think, in this current environment because of the uncertainty going forward. I guess the risk is, in terms of the bounce, economies are opening, and therefore people, expectations are manufacturing comes back online, etc. But if the risk clearly is that maybe lockdowns happen again, then what happens? And you're right in that that some things that have done very well have been very large cap companies. However, if you kind of drill into that, yes, you've got the Netflix doing well because everyone's sort of shut in their homes, etc. But actually, one of the main reasons they're doing better is that they had stronger balance sheets. So if you look, particularly in the US, things like mid-cap companies and smaller cap companies generally have increased their debt levels significantly relative to history. And that's one of the big reasons why they're getting in, why they've underperformed more recently. So it's not just a sort of large cap versus small cap or mid cap. It's very much a strong balance sheet versus weak balance sheet argument. And clearly, if you have a weak balance sheet, that will take some time to work out, if you like, and that may be harder as you're going through the current market environment. However, when we're thinking about our portfolio and how we're sort of trying to position, we're very conscious of not being overly defensive. So if you're purely a defensive company, you're all in consumer staples, then yes, you might do great when the market falls, but in the recovery, you'll struggle. And ultimately, we want to do well across the market environment. So the way we're sort of thinking about it is to have the right balance between, continuously having high quality companies, but a balance between the kind of quality defensives, the healthcares, the staples companies we've been talking about, but also the kind of quality industrials, as we would describe them, or the quality cyclicals. So within those types of areas, you've got things like Schneider Electric, for example, or ABB in Switzerland. So that's a company that does things like automation and robotics. So robotics being quite hard hit. Factories not being online. So they've seen quite a big hit to that. But actually, they've got quite a lot of cash. They can get through this. They've paid their dividend for this year. And actually, what they're both seeing when we talk about and when we listen to their recent results is they're seeing a really strong move towards more automation, faster move towards digitization, for example. So some of these trends that we were discussing earlier, the businesses are looking at what's happened and saying, actually, we really need to improve our efficiency. We need to really accelerate some of these things. So actually, some of these companies we're owning that are more cyclical are actually starting to pick up and could do really well as the sort of businesses and management teams start to think about what this means for their companies. And I think that's a really interesting place to look at. Similarly, we looked at a company like Taiwan Semiconductor. So they're kind of one of essentially the global leader in foundry. So they make all the semiconductors for all the IT businesses around the globe. And they are actually increasing their capital expenditures this year. So what they're seeing is they are seeing longer term demand. So they're actually ramping up their ability to meet that demand. And I think that's a really good read through for some of these types of industries as well. And I think that's, again, here's some areas in cyclical places you might think that have done very badly, but actually could do quite well coming out of this. So again, I think that's sort of looking for those companies maybe with some of those tailwinds in those more cyclical areas is something we're really interested in.
Ian, do you look through companies now that are cutting dividends, knowing that those dividends are likely to come on stream, or given that you're obviously dividend focused, given the income that the portfolio generates, does that force you to get out of them?
Yeah, as I say, we've managed to avoid any companies actually cutting or sustaining the dividends so far. I don't think that's necessarily guaranteed for the rest of the year. We'll have to see how this sort of pans out. But I think it's what you've got to look at when a company's cutting their dividend is why they've done it. So if you go back to those four things I was talking about at the beginning, you might have a company like Danone, for example. So, the big French company making yogurts and water and things like that. And they've actually done pretty well. And they'd be very easy for them to pay their dividend as much as they paid last year, if not a bit more potentially. However, there will be a significant pressure on them from the French government to reduce that payout by 30%. So we're going to see what they do come June, but that would be a good example of a company where technically they have cut their dividend, but actually, there is a very high probability that will come back the following year because they have only done it through sort of pressure from political pressure, as opposed to because they have to do it, if you like. So things like that we'll be quite comfortable with. Other areas, as I say, things like commodity stocks, for example, oil price being maybe lower for longer, they're going to struggle to potentially bring those dividends back on stream quickly. Similarly, things like advertising agencies, we saw WPP this morning just announced pretty poor results. They suspended their dividend this year. We don't own that company, but again, you kind of look through that and think, well, actually, is that a company that's really going to come back with their dividend quickly? Not so sure. So I think that's sort of the way we've got to think about it. Okay, great. So,
as we've gone through, I've tried to address some of the questions that have come through, and we have got a lot of questions through. There's a good question from Austin Sutton, who's talking about the relationship between economic recoveries and stock market prices. I think we've covered a lot of that. One thing I might add to that is that, remember, stock markets, tend to be forward-looking. They tend to, to try and price in news that's coming. and I think that also is interesting, Ian and Matt Roberts' point in terms of, companies that have done well probably over this period, other than the obvious beneficiaries, but also companies that have very strong balance sheet. But as we come out, maybe the more cyclical names that are still very cheap, some of those value stocks that Matt Roberts and Will have talked about in the past, might be the winners going forward, and some of those are still at very depressed valuations. Let's kind of quick fire questions on trying to get through some of these questions. Let's talk, go to Will very quickly. Rather than everyone comment on each question, maybe Will and just Charlie touch on this one. Will, emerging markets, I know that's an area that you like. Give us 20 seconds on emerging markets, and maybe Charlie, your view as well would be interesting.
Well, I mean, I think emerging markets, when you think about the drivers of long-term returns, valuations play a key part in that. In the short term, valuations are not important, but we know that when we look at 5 and 10-year returns, valuations is a big driver of that. And emerging markets, win out on that basis. They have much lower valuations, particularly when you compare them to regions like the US. And so, we think, particularly if you're selective with emerging markets, the opportunities for outperformance and for strong returns, these sorts of valuations are very much in place. So we think it's an area that has great opportunities. Although you do need to be, in some areas, reasonably selective. There are some countries that are going to struggle with this crisis, and particularly have an impact on their currencies. So we think it's important to be selective in some areas, but broadly speaking, emerging markets are a very interesting place to invest.
One for active management, I guess. Charlie, what are your views on EM? What are your views on the debt side, maybe, or the equity side? And maybe the impact of the dollar.
Yeah, so dollar strength has kind of confused most investors for a long time now. There is an expectation clearly that it will weaken from here, and that will obviously help to a certain extent the debt side on the EM's equation. But we haven't really talked about overall global growth for the year, and it might be worth just pointing out that the real pain is going to be experienced by the developed markets this year. IMF estimates now are for 2020 GDP of a negative 6% print at least, whereas emerging markets in general will only see a kind of 1% negative print. So the relative proportion of EM output for GDP as a overall contribution will only get bigger from here because they're falling less, and they were obviously a bigger proponent of the overall kind of split in the world kind of GDP number anyway. So it still suggests that you would be allocating more money over time going forward to EM in any case, and that's a policy that we've been adopting, will continue to adopt. So we like debt. We particularly like certain levels of the debt side, just on the carried trade that you can make out of it, compared to Western sovereign debt, which is pretty much yielding nothing on a real return. But also on the equity side, so we've got very overweight positions to EM equities in general. If you look at the oil price, some areas of the EM kind of makeup will get hit by that. Clearly, the exporters, as we've already talked about, but a lot of the EM nations, they don't produce oil, and they're importing clearly a high proportion of that, so they will benefit from clearly a lower oil price as well. Again, it all goes into the mix, and basically the output is that EM would probably have a better outcome out of all of this than developed markets in general.
Okay, so thanks for that, Charlie. There's a question here about why deflated price is not so good for the consumer. I guess what Matt Roberts is alluding to there, I think short term, some of these can be good for the consumer, but if deflation continues to persist, what it typically does is stops the consumer spending because they wait for things to get cheaper. And you get into this negative feedback loop, and if people continue to put off purchases on the expectation they will get cheaper, then clearly that is not good for economic growth. And that is why central banks and governments around the world are so fearful of deflation, because they feel that they can control inflation ultimately better than they can deflation, because once you have inflation, you can slow an economy down in their eyes, and much easier. So I think deflation is the fear of everyone. There is a question, maybe. Well, this is a tough one, maybe for Mr. Roberts, because I think I know Will's views on some of this. So I'll try and go for an independent view. There's a question here: is how much of the bounce is due to the huge economic stimulus versus the by governments, versus the fact that some of these large cap players are clearly good businesses. It mentions Amazon, Zoom, Facebook, Google, and Tesla. I think a lot of that makes sense. I'd have to say I would disagree slightly with Tesla, but maybe I'm biased here. But Matt, what's your view of how much of this economic recovery is the quality companies versus just fiscal stimulus and a drive to short-term winners?
That is an excellent question, and it's impossible to measure accurately. My view would be that without the stimulus, we would have seen a very significant fall in equities, way beyond what we had, and probably way beyond what we saw in 2008 as well. I think you could well have seen an equity market that was down possibly 60 or 70%. And the scale and speed of the stimulus was absolutely critical in permitting markets to rebound. And I think the equity market is the thing that is most visible as part of all of this. But one of the reasons that we know that the economic shock was so significant is by looking at some of the bond markets, some of the credit markets. And if you look at what happened in the high yield bond market, for example, in the mortgage bond market in the US, and in some of the emerging market debt markets, a number of those markets fell sort of by similar amounts to the equity market. And what we've seen is that the markets that have been directly supported by the Federal Reserve, so for example, the investment grade bonds and some high yield bonds, we've seen quite a big rebound in a number of those markets, and in sort of in tandem with what we've seen in the equity markets. But the markets that haven't been supported by the Federal Reserve have not bounced, and are still sort of languishing down at the levels that they fell to in the middle of March. And so I think that tells us something about what the monetary fiscal stimulus has done to markets. And so my best guess would be that a very large proportion of this bounce is a consequence of stimulus, and not necessarily as a sort of result of people looking through the turmoil to future earnings. The other thing that I would add to that is that I think these days there are a lot of machines that buy and sell equities, and automated trading, quantitative models, and a lot of those machines do not know what coronavirus is, and they certainly haven't experienced an economic shock in their back tests that's equivalent to the one that we're going through. And a number of those machines will be buying equities, buying the dip. And so I think it's important to bear that in mind as well.
So I think that's an excellent point. I think that ultimately, I guess what you're saying there is that and Will mention it as well. I think that eventually people will look at the economic fundamentals, and you will start to get dispersions of return, which I suspect is probably a positive, for active management, because I think you need this sort of change in leadership for active managers to start to really perform. There are questions. People love shapes in our business. People talk about U shapes and V shapes and square root shapes. I heard a Nike tick shape. Well, the shape of a recovery, if you could put a shape on it, what would it look like?
Well, I think I said a V-shaped recovery, which is the very sharp bounce back, is unlikely. given the sort of the scale of the impact already that we've seen, even if we do get a vaccine this year. So a slower recovery than that, undoubtedly very weak this year, this quarter and next quarter. But then a recovery from there. So I guess more U-shaped, if we have to put or maybe sort of tick shape, is more the case, given the impact already that we've seen. But I think sort of the worst case of the L, where it falls and doesn't recover, as I say, I think has been arrested by the central banks. And I think the other point to make about the central banks is that they've done a lot already, but the lessons from the last 10 years is that they don't stop. So if we do get a further weakening of economic growth, we don't get a vigorous recovery, then they will do more. And we've already seen governments doing more in terms of government spending to prevent the worst of the slowdown. And we think we'll see more to boost the recovery as well. So I think that's one of the key lessons is central banks are already ready. They've already acted very quickly, but they don't stop. They won't just give up if this economic impact is worse than some people are fearing at the moment. They will continue to act.
The interesting thing that my takeaway from listening to all of you speak is that some of the worst case scenarios have sort of been taken off the table for the points you just mentioned there, and many others have mentioned. There clearly could be some volatility, and clearly there are some opportunities. But as long-term investors, I think Charlie said we will get over this, and I think that's a very that is an obvious but often forgotten point, and therefore I think the long-term prospective returns of equities from here, not only remain a good investment, but potentially the long-term prospective returns from here are better than they were, when people were piling into equities at the back end of 2019. So I think, that certainly is reassuring to me, hearing you guys speak in those words, and also knowing that you guys have these levers, all of you have these various levers to attract to use through active portfolio management. I want to finish with one question to all of you. If we could keep it brief, it's a big question, but if we could keep it brief, and I suspect it affects asset classes. But do you think there is, and maybe start with Charlie and kind of go backwards, do you think there is some big fundamental changes that are going to act in the way that we all behave, and therefore we've got to be very aware of that as we get out of COVID-19, the impacts of commercial property, working from home, the speed up of technology, or do you think over time we kind of, we're creatures of habit and we revert back to norm? Why don't we kick off with Charlie?
Yeah, well, that's a very deep philosophical question to finish on. But I guess if this experience has taught us anything, it's that we can still operate as effectively as we were all crammed into an office. It hasn't changed the way that we're investing or anything to that extent. So there might be pressures on clearly office space. Going forward, clearly, a lot of people will not want to go rushing back into the kind of chicken coops that they were operating in, and we're certainly not going to do that as a company until we get to a much more lower level of case kind of growth in the UK. So yeah, I can only expect it's going to get very, very different going forward. As the tech has advanced very quickly on the back of this crisis. I mean, that's the kind of positive silver lining I guess you could make out of all of this. When you do get into adversity, then things do tend to change, and that's when benefits can be had from that.
Ian, any thoughts on that?
Yeah, I think broadly agree. I guess from a company specific point of view, I guess we talked a little bit about some of the companies. We own, talking about that kind of acceleration of digitization of their business models, the move towards automation. I think both of which are trends that we have already seen and are already in situ, if you like. But I think there's a sort of acceleration of those types of ideas and trends. And I think as well, maybe a slight simplification of things like supply chains, maybe sort of onshoring of, or maybe sort of slightly more localization of manufacturing and things like this. And I think that's a kind of a longer term trend. But that's sort of, I believe when we're listening to companies, what they're talking about at the moment, that's kind of what they're thinking about. And kind of creating kind of more robust supply chains and being able to do more of that locally. I think that's again another interesting trend, and companies that are more nimble, well positioned, able to adapt to those types of changes will do better than those that aren't. And I think that's another thing we'll be looking at quite closely.
So Matt, just on that, but maybe because I know that your view is, as you said at the beginning, the acceleration of some of these mega trends, but on that kind of reverse globalization story that Ian's hinting at there, this idea that maybe we do more manufacturing domestically, maybe some of it shifts from the east to the west. Are there implications for inflation there?
Well, I think, first of all, I think the periods like this during the course of human history have been the spark of innovation and change, and I think that this period will be no different. And I think maybe it might even be an example of a huge amount of change in a very short period of time, which is perhaps one of the more exciting parts of this. But otherwise, a very difficult period. I think that there is the potential for inflation for a bit further down the road as a consequence of it. As we've discussed, there's a sort of incontrovertible deflationary impact of people staying at home and not being at work. But because of that level of stimulus, you've got a lot of money sloshing around in the system, which ultimately, when it gets sort of put to work, leads to a certain type of inflation further down the road potentially. And so that's well worth looking out for. And I just want to clarify an earlier comment as well, because I know there's a question on this, Matt, about the is the machine trading potentially worrying and causing overvaluation? Not necessarily. The way the markets have evolved nowadays is that machines and stimulus effects from central banks are sort of part of the fundamental picture that we all have to take into account. It's not as simple as just looking at the price earnings multiple anymore. We have to take into account what central banks are doing, the impact on liquidity that has, and it may just simply be that we're at fair values and that we just avoided a major liquidity, an even bigger liquidity event because of the stimulus and because of what the machines have been doing. So that's just to clarify.
Just one very very quick point, just to elaborate a little bit. I know I'm very conscious of time because we don't want to take too much of people's time, but you talked about the acceleration of innovation. Ian talked about it. Charlie did as well. What's the impact actually for things that were already accelerating quickly, solar, renewables, given that actually do people put off buying the electric car now because it's going to cost so little to fill up your car that maybe you wait a few years for the technology to catch up? The efficiency of solar and renewables from a relative cost perspective, I guess, have just got a lot more inefficient as oil and things have come down. Does that put a pause on some of that acceleration of renewables trend?
I think there's some competing forces there. A low oil price isn't automatically good for renewable energy, but equally, I don't think the vast majority of world governments are going to give up on the move to decarbonisation of their economies. It'll be interesting to see what happens with the US election on that one as well. But also, I get the sense that again, just the sort of the mass home working situation has led to a very large sort of reconsideration of people's habits, whether that be using aeroplanes, just the day-to-day consumption habits, which may well lead to some more permanent changes. So I think there's some competing forces there, and I don't think the move to renewables is just going to disappear because we've got probably a temporarily low oil price.
Okay, so last question for Will. Feel free, Will, if you want to touch on some of the points that we were discussing there about what might change post-COVID. But there has been another question that comes in, is that, and you sort of alluded to it. I mean, there's one question about whether these quant models that Matt alluded to have driven equity prices up to a new high level. I suspect it potentially has in a particular narrow part of the market, but maybe a more interesting part is what is your view on instruments like Tier 2 capital and some of the more esoteric debt space and things like that? Will they remain very volatile for a long period of time?
Well, I think I do think there's been a very big impact, as Matt alluded to, on whether you're a beneficiary of stimulus, of central bank actions or not. And for now, I think remaining in areas that are liquid is very important. But further down the line, less liquid securities will be where some of the great opportunities are. Certainly the more esoteric areas. We think liquidity is very important in this environment to be able to reposition portfolios. But for now, there are very clear winners and losers, and part that's defined by central bank actions.
I guess, yeah, that's an excellent point. Having dry powder is probably not a bad thing to deploy as we get greater clarity. Listen, I want to thank everybody for dialing in. We've had a huge number of people dialing in, over 200 people, which is a phenomenal effort. Thanks all you guys for the huge responsibility. We all know it is looking after people's capital. Thank you very much to the guys at dVAM and all dVAM's clients for the continued support. All of you that dialed in last time. And the ability for those to stay invested, because we know that everybody has, and to participate in the bounce that we've seen, I think is testament to you as investors, and also to dVAM and their advisors to guiding their clients through this. The one comment I would leave you with regards to changing habits, if any more baking goes on at my house, I think I'm going to have my own nervous breakdown. So hopefully we all get back. And I don't have to be clearing flour up for the next 9 months. So thank you very much. Speak soon, and take care and stay safe, everybody. And we look forward to hearing from you all in the future. Take care.